Hello and welcome to yet another session in Technofunda Investing channel. And this is a very special session where I'm going to answer a lot of your questions. It is called Ask Me Anything live session. Okay, so that is what we are going to do in this particular session. So what I will ask all of you to do is just type in your question. Let's queue it up. We'll take the question first in first serve basis and let's answer all your questions for next half an hour to 1 hour. Let it flow in and let's get started. If all of you are ready, just type ready in the comment box. Welcome to this special edition of Ask Me Anything. And hope you are all putting your questions in the queue and let me start answering each one of them. Okay, so I'll take your questions on the screen. You will be able to see the screen in front of you where the questions are coming. And then let's go deeper into each of these topics. So the first question is coming from, Sudipta Sutradhar. He's saying, how to find exact valuation of stock to invest. There are multiple ways to invest and get valuation for the stock. The first way in which you can do is based on peer valuation. Like say for example, if you are analyzing Infosys, you can see what all their peers are trading at. So you can think about like say TCS, you can think about HCL and see what multiple they are trading. So if say TCS and HCL at a 20% growth, they are trading at 20 times multiple, and if Infosys is growing at 20% growth but is trading at 18 times price to earnings, like 18 rupees is whatever 18 times earnings to price, that means it is probably undervalued. And the same way, if it is 22 times, you feel that it is overvalued. So that is one way of doing it. The second way is you do DCF. It is called discounted cash flow. You basically see what are the earnings and ultimately the free cash flow of the company, and you discount it for the entire life of that company. Say for example, any shop that is giving you 100 rupees every single year, what will you give value of that today? That is how you think, and then you discount. And third very powerful way which I use, I call it, it's called reverse DCF, which I pretty much use, is a very popular method. So what you do there is basically you try to go back. Okay, so I'll just log into my Tijori. Tijori is nothing but a tool. It's not like a literal Tijori. Okay, and I'll show you this example so that you can understand what I'm talking about. Let me log into my account and let me show it to you. Alright, so let me share the screen now and hope all of you will be able to see the screen. So this is a tool called Tijori. I go here and say for example, I go for Infosys. And then I go to different financials which the company is having. And in that financials, in the end, you will find reverse DCF. So it says, currently the earnings are say 1400 crore. If I discount it at 15%, and whatever current multiple is there, it goes to 10 times. Okay, whatever right now the valuation is there, it needs to grow 63% over next 10 years if it needs to justify that kind of multiple towards that. So now you have to just think in a reverse way that whether Infosys for next year 10 years can grow 63%, yes or no. And most likely, these kind of growths are not sustainable. So that gives you answer that it is not sustainable. Now, what if your thought process is that from current multiple, it might come down to say 20 multiple or say 15 multiple. Then what? So then, it is 57% kind of growth rate. So this is how, it's one of the most easiest way to value the company. Basically, you just go reverse and try it out. That's it. Okay. So you just focus on one thing, that is growth, and that will give you an answer about what is going to happen. Okay. So hope this was clear. Sudipta Sutradhar, thank you so much for asking this. Now, Prahlad Agarwal is saying how to invest in SME stocks, your view on SME stocks opting for migration to main board. So there are two questions. The first question is, what about investing into SME stocks? So there are different SME exchanges on BSE and NSE. There is a separate SME platform where you can trade these stocks. Some of the brokers allow all the stocks to be traded through your trading account. Some of the brokers don't allow it. Now, assuming that you are allowed to go into SME stock, your views on SME stocks opting for migration, right? So first thing is, it is a high risk area. See, the disclosures are very, very minimal. The companies are very, very small, and the promoters are not very, very well known. So it is very important to do a lot of ground level research for these kind of companies, and also make sure that the promoter whom you are betting on, it is mostly the bet on promoter more than any business, because if promoter doesn't want to share the wealth with the shareholder, you will not make money in SME stocks. Okay, there is a lot of manipulation that is possible in the SME stock. Now, for companies which are migrating from SME to main board, it is a good thing. One, because the disclosure will increase. Second, there are a lot of regulatory things which will come into the picture. So you will automatically have a lot of bigger resort in terms of regulatory, disclosures as well. And third, most important is the liquidity will increase. Okay. So that is where, it's a positive one-time effect where there is an increase in liquidity and the visibility of the company. So you might sometimes see a re-rating in a company when it moves from SME to the main board. And there also a lot of institutional also enter, and that also gives you that trigger in place. Okay, so that is where, that is what my view on SME is there. You can recently check Sarka Paints, which was in SME, then it came to main board. And because of that, it got a lot of liquidity and a lot of re-rating. That is a very, very recent case study if you want to check it out. Okay. Superb. Thank you so much for asking. Devender is asking, sir, intraday profitable hai ya swing? So see, I have burnt my hands in intraday and F&O. Having said that, anything which you do, if you know how to do and if you do it properly, you can still make money. The reason for me for switching from intraday to swing and long term was, one, because of avoiding a lot of screen time. See, I didn't wanted to be like a intraday trader, sitting in front of screen for 6-7 hours every day, and always refreshing the price every single day and increasing my blood pressure. If you see the common trait, in terms of stress which it generates, I've seen a lot of my trader friends, some have hair loss problems, some people have poor eyesight, some people are not able to sleep at night, some people are not able to eat properly. So I wanted to make more money per unit of stress. Okay, so less stressful, more peaceful way. That is definitely positional, which is swing. And swing also, my definition is few weeks, few weeks to few months, not like just few days. Okay, so it is few weeks to few months. And then if it works out, I also want to take it to a long-term bet. So that is my view, but you can make money from both. It is just that the unit of stress you are taking is much more, in the intraday and F&O trading. And plus, of course, once your emotions are coming in, you get in, get out very quickly. Your, systems you are not able to focus on. You can't put alerts. So a lot of drawbacks are there, because of which a lot of people are not even being profitable in that space. Okay, so thank you, Devender, for asking that question. Hope that was useful. Okay, so Sunil Kumar Yadav is saying, I've come to know you through face-to-face, sir. After that I purchase your book, You Can Compound. I want to know that being a government employee, which are the best instruments to invest for some income monthly. Okay, so for monthly income, if you want to, focus just on monthly income, I would suggest first focus on the layer of your fixed income bucket. So fixed income bucket is your, FD. If you are in a lower tax bracket, I'm assuming if you are a government employee, you might be on a higher tax bracket. So you might want to explore something like Bharat Bond ETF. You might want to invest in some government PSU bonds. You might also explore some of the quasi instruments like commercial real estate, and REITs are available online. You can buy it and you can get some, rental income, fixed income out of it. I've shared a video. You can go to my YouTube channel and check Vivek Mashrani REITs, and you will find a video on this entire piece. And then, of course, you can also invest in some of the InvITs which are available. These are all infrastructure project based instruments where it gives you some fixed income every single year and every single month also. Now, another thing which you can do is you can do some positional, investing, which is more like a swing kind of journey, where you can bet on short-term earnings trigger, like anything between few weeks to few months, and that will also help you generate consistent return. But that is not always consistent if the market is non-trending. Like right now it is a non-trending market, there are only very limited opportunities available, your return might still fluctuate. So as soon as you enter equity, your returns will still fluctuate, even if on a long-term portfolio you get some dividend, which is again a recurring income. This will also still fluctuate based on the earnings of the company. So first I would say protect your layer with fixed income, with any kind of bond kind of instruments or REITs kind of instruments or InvITs kind of instrument, and then you can fixed on equity positional investing as well as dividend to add a layer of fixed income to your bucket. Okay, so hope this was clear, Sunil. Thank you so much for asking, and great to have you here after watching face to face. You have come here, so thank you so much. Superb. Okay, how to choose best stock and how can we evaluate that stock? Okay, so I have actually taken a deep dive session on this, and I've shared a very powerful template also. Let me see if I can show you the video. So you can just search with this video on my YouTube channel. It's there already in YouTube channel, and I've shared a powerful template which you can use right away to use that for your stock screening and analysis. So it is called Fundamental Analysis of Stock Excel Screener, and I'll also give you the link of Excel. Maybe I've also posted in the comment, just check it out. But I'll share the link of that Excel also so that you can download it right away. Okay, so this is the link of the Excel, you can just check it out. Okay, so this is where I've comprehensively covered, and in my community I have a paid community also where I teach this deep dive. It is called Core Portfolio Blueprint, and where I have my proprietary machine formula where I go deeper and I explain this. But this video also will be very useful if you are just getting started. Okay. So that is Prashant's question. Thank you so much, Prashant, for asking that question. Abhishek is asking, should we have a separate demat for core and satellite portfolio respectively? I would suggest yes, because if you have a separate demat account, one, it brings in discipline. Okay, so you know that satellite portfolio is for short to medium term, core is for long term. And ideally choose a high brokerage account in your core, so that just because of high brokerage, you don't sell in and out very frequently. Another advantage is the return calculation, right? You will exactly know how you are performing on satellite. You will exactly know how you are performing in core. Having said that, if you are just getting started and if you have only one demat account, you can even create two sections in your portfolio, and you can still treat it as a core and satellite separately. You can still calculate the return separately. It is just some extra effort, but mentally, it just gets disintegrated when you have two demat accounts. So that is how you can go about it. So I personally have HDFC Securities and ICICI Direct for my core portfolio, and predominantly I use Zerodha for satellite portfolio. That is how I go about it. Okay, so thank you so much, Abhishek, for asking that question. Glad you asked that. Superb. Shushrut is saying your thoughts on Nifty Bs and Bank Nifty Bs. So these are good instrument to park your money for short term, or if you want to do indexing in Nifty and Bank Nifty, these are good ways to do it. But my experience and from many investors I've seen who have done these things seriously, if you are able to actually focus on right kind of stocks and you can build your portfolio on your own, you can outperform indexes by a huge margin. We have so many community members who have done this, and it is just the right kind of stocks you need to pick it up. So yes, it is a good way to passively do indexing versus mutual funds, but even better is if you invest into stocks. Okay, superb. Opinion regarding Adani Stock. So see, again, this is not a recommendation, but it's very difficult to value and understand what is going on inside this entire Adani story. So when there is that kind of case, I always prefer to stay out. Okay, so having said that, you can do your research and see if any company is good. I think the asset wise, port asset is very, very powerful asset. They have got some competitive advantage there. They handle huge volume, of ports across, that particular Adani port itself as a percentage of the entire volume in the entire country. So that ways, it's a good asset, but it's a very, very tricky way in which you need to analyze. And if you see valuation also, some of these companies, the valuations are also haywire. So do your due diligence. I'm not saying it is good or bad, but it's a very, very tricky area at this point of time. Okay. Awesome. Imran Kazi is saying model screen to run in screener. So are you all willing to see how to go about this? Just type ready in the comment box. I'll show you what all things you ideally need to include in the screen. Okay, and this topic I covered deep dive in one of our implementation program, which is called Hackathon. I'll show you the checklist what I use in the hackathon so that all of you can model it, and some of the elements you can pick it up. I'll show it in short how it goes about, but once you go deeper, you can obviously understand much more. So I'll just open the screener and let me show you what all things ideally I look for when I look for long-term compounding companies. Okay, so let me share the screen now and let's go deeper inside this. So this is the screener template, and you can upload your template also here, and lot of things you can do here. But let's create a new screen. So what I do is I use first 3 parameters which are super important to see whether a company is a long-term growth company or not. So first I see sales growth, whether for 3 years it has at least grown by say 10%. Then I do sales growth if it has at least grown by say 8% at least for 10 years. And then near term sales growth, like how it is right now, say if it is more than 10%. The next is I want to see the earnings growth, right? So I just do earnings growth. I think it will be PAT growth over here. Okay, so let's do profit growth 10 years. I want at least 15% of growth, right? So I do 15% and I do profit growth for say 5 years greater than 15, and profit growth, recent profit growth also I want to check. Then third very important thing is what is their return on capital employed? What is their ROC? That gives the quality of the company. And in my entire machine formula which I have, H is for high quality, right? I don't want to compromise on the quality of company. So I do return on capital employed say 10 years. I want at least 15%, right? So that I capture it. Then return on capital employed say 3 years greater than 15, and return on recent capital employed also I want at least 15%. Then I want to do return on equity. So same thing, I do it for return on equity at least 15%. And then I want to also check operating margin. Okay, so whether operating margin is at least 10%. Can anyone tell me why around 10% is required when it comes to operating margin? Can anyone tell me in the chat box so that I know? Yeah, so that I know how intelligent our audience is here. Awesome. I think a lot of you are on track. Yes. So it gives a competitive advantage of the company, right? So these are critical parameters which I run. And then of course there is entire checklist which I do. This is like a comprehensive process which I cover in my hackathon, which is an implementation program inside my community. It goes on for like 2.5 hours. But I'm just giving you idea in terms of what all things and how you can create the screen. And then you can just run this query. You will get list of the companies. And then of course there is a second layer. So here we got some 50 to 60 companies, 55 companies we got. There is a second layer where we need to do further filtering. And that is where, I cover filtering in terms of how you can see the charts and filter your companies. And there is a ranking model in one of our tools. Okay, so I use a tool called Ride Winners. And then there we have an entire ranking module. Okay, so you can actually rank the companies and then filter down further to your core portfolio and select those in your final list. So this is how, long answer to your short question, but hope this was useful. Thank you, Imran, for asking that. And you can use these kind of screens to filter your core portfolio stocks. Okay, great. Yeah, Pradeep is saying you always take positions after breakout. Any reason you don't prefer? No, no, absolutely not. So I prefer, in fact, positions before breakout also. It is called cheat area, and we do something called as quantum mastermind every single Monday, and that is also the major focus there. Okay, so we try to find out where the risk reward is much better, and many times it is before the breakout also we try to take. It's called 25-75 strategy, which we play. 0.25 just before the breakout and 0.75 just when the breakout is happening, so that we can control the risk reward. And even if the breakout fails, the risk is like less than 2% on that position. So that is how we actually go about it. But sometimes if the company is very, very convincing, even after the breakout has happened, if the percentage near the support zone is nearer, like if it is less than 8 to 9%, then even I prefer taking breakouts, because then your risk reward again is very, very favorable. Okay, so it's both ways, not just the breakout or after the breakout. Okay, in fact, we also do low cheat area, where it is just forming the base, and just after the completion of base we do it. Okay, so thank you so much, Pradeep, for asking that question. Okay. Which chart is most promising for swing trade, hourly, daily, weekly or monthly? Okay, so what I do is generally I prefer daily and weekly charts for positional investing, which is called satellite portfolio. And I've created a dedicated video on that. I would highly recommend all of you to watch that whenever you get time. I'll just show you where, which video it is. Okay. Yeah, this is the video, you should check it out. How to outperform Nifty returns on my YouTube channel. Just search with this name and you will find this entire video about core and satellite concept. So basically in satellite, which is more of a positional investing, you can consider similar to swing. The major difference between swing trading and positional investing is you also understand the fundamental trigger. That is the major difference. A lot of people just take it based on price volume action and charts. That is called swing trading, because then you are not applying your head what is happening with the company and why it is moving and what is the fundamental trigger. But what we do is we also try to understand what is the fundamental trigger behind that company. And the view is slightly more longer if the fundamental trigger is very, very strong. So that is where I call it positional investing rather than considering as a swing trading, but it is almost equivalent to swing trading if you remove the fundamental part from it. Okay, so that is where I follow daily and weekly, and for long term core portfolio, it is mostly weekly and monthly. That is how the balance is looked upon. And you can use hourly as well as 15 minutes chart also, just to do your multi time frame analysis, whether your view on daily is syncing with the hourly chart as well as 15 minutes chart, or whether daily is syncing with weekly and it is syncing with the long term monthly chart. So basically you see whether your minor trend, intermediate trend and major trend, all of these things are aligned. Okay, so hope that gave you clarity. Thank you so much, Narendra Prasad Singh, for asking, and hope all of you are liking this session. This is slightly new format I just tried because a lot of people are asking me questions on my Telegram, and there were a lot of questions pending also from long time. A lot of you were asking. So I thought let's do this separate session itself on YouTube, so that all of you can benefit together, and hope this is useful to all of you, right? And if you are finding it useful, just hit a thumbs up so that I know it is useful for all of you. Okay, so let me take the next question. Let me just search what is the next question. Okay, so next question is from Noman Syed. How can an individual with a modest income and no large amount of capital invest in stock market and potentially generate substantial return? Should he do intraday to build capital first? So this is a very tricky question, right? So sometimes, see, market is like this, okay? When you ask for more returns, it will not give you more returns. When you don't ask for it and you say, okay, I'm fine with it, it will give you more returns, okay? So when you are desperate, what happens is you don't follow the process, right? Our emotions takes over. And when we are not desperate, when we are doing it peacefully, when we are following our system, that is where market rewards us much more, because now we are not wanting it, we are just controlling the risk. When you just control the risk, it will give you more return. When you are focused on return, it will give you more risk. If this was bulb on, just type bulb on in the comment box. That is what I have experienced in many years of my investing, right? And that is where multiple things are so important. One, never cross your position sizing. If you put too much of capital, more than your capacity, your emotions will start taking over. If you desperately want to take a trade or find a stock to invest, and you just compromise on the quality or process, again you will end up into bad company or a suboptimal kind of choice, and then you don't get return. But when you are willing to wait, when you are willing to find that right company which fits in your analysis, and you are focused on your risk part, that is where it rewards you much better. Okay, so that is how you have to think about. Now, having said that, if it is a tiny capital or a small capital relatively and you want to make big return, definitely intraday trading is not the way to go about. I started like that. When I was in Infosys, I used to earn like 14,000 rupees back in 2017, 2007, 8, 13, 14, 15 years before. And that is where I was so desperately doing it just to make quick bucks, and actually I blew off my entire account. Okay, I lost all my money in that process. And when now I'm doing exactly opposite, when I'm financial free, I don't want to take unnecessary risk, and I'm just focused on my process without worrying too much about return. It is actually giving me much more. So I would say try to find some other sources of income in the initial stage, but don't get desperate in your journey. Yeah, and hope it was useful to you and a lot of other people. If it was useful, just type useful in the comment box. And if you have not yet subscribed to this channel, if you want to stay connected and learn like this every single week, just hit that subscribe button and let's stay connected for long term. Yeah, so let me go to the next question. Shanu Jain is asking insurance, reinsurance growth in India. Perfect. So insurance, reinsurance business growth possibility in India. It's a good long-term mega trend. Okay, overall there is a lot of possibilities. The country is huge. The possibilities are immense, and there are very few companies here. But only thing is, near term there is a headwinds. There are recently, if you go to the last budget, there was an announcement that a lot of these annuity plans, which was a cream for all these insurance companies, that is no more having any tax advantage. So the signaling which government is doing is that you purchase insurance just for the sake of insurance, not for investment purpose. And if you have seen the budget, it is also nudging towards the new way of reporting and the new norm which we are moving to, new regime where we are moving to. And there you will not have any kind of these ATC benefits and ATD benefits and all those things which were predominantly there in India under the old regime. So that way, the entire shift is happening. I would say, it's a temporary headwind. So wait and watch. Once this headwind is gone, then probably you can think about this entire space, to invest in. Okay. So hope that was useful. Shanu Jain, thank you so much for asking that question. Okay, Vamshi Krishna is saying how to use screener for companies for which capex is coming online. So there is a very interesting thing, and I know you are a member also of our community. So what you can do is you can go to our guest session, the screener session by Ayush and Pratyush Mittal, and watch that. But predominantly what they do is they are looking into capital work in progress. So I'll just share one of the examples to let you understand this. Let me share the screen. So what they do is basically they look for change in capital work in progress. That line item you will find in balance sheet below the fixed asset. So if you see this point, can you see this? So say this is a privy balance sheet. In previous balance sheet in March 2022, it is showing 370 as a capital work in progress. Then here it is saying 174 capital work in progress, and then it is showing 170. So basically this 370 is something where you ordered the machinery, You have started doing the capex, but it has not yet got converted into fixed asset. Okay, and now if you see the next number over here, this fixed asset number has increased. Basically, some portion of this 370 has gone into this fixed asset. So to run a query, you can say like fixed asset CWIP, it is increasing say 2 times or 3 times than the previous year's CWIP. That is how you can run the query, and you can find companies which are doing capex, but it is just not on steam, it is still work in progress. Because as soon as it is done, it will get converted into fixed asset. So if this was powerful hack, just type PH in the comment box. All of you can type PH. This is how you can smartly, find out opportunities, and much before it is coming to notice to all the participants, you can actually get inside it. This I learned from Ayush Bhai, and we have a dedicated video of Ayush Bhai and Pratyush Bhai, founders of Screener.in, which I was showing. That tool has been made by them, and we have a dedicated video. You can go and watch it later on so that you can get much deeper idea around this. Okay. Superb. So let me take next question. Okay, Vivek Kumar is saying how to know which stock to invest for long term and which for short term. So basically, that is the reason I've created this core and satellite framework. Okay, and I would highly recommend again all of you who wants answer deeper way. I'll answer you any which ways, but if you want to know in a deeper way, just go to this particular video, how to outperform Nifty returns, and you'll be able to get it. See, the thought process is very simple. Which stocks, just think about this, okay? I want all of you to just close your eyes and think about this. Which stocks will you be able to hold for long term and will give you return for long term? Think about this. Just think for some time. Which kind of companies which will grow for a long term and you will be able to make returns for the long term? The first and foremost thing you should be checking is something which has strong competitive advantage, which is not a commodity company, right? And second, which has longevity in the business model. Like if you think about something like cloud computing or DVD company or a mobile phone company, it is a highly disruptive company. Every single day there is something new that is coming up. But if you are investing in a coffee company, whether new coffee will keep coming again and again, right? Now it is a commodity company, but if there is a special type of coffee, or say like how our rice is there, right? Basmati rice. Only at some places that basmati rice grow. Only at some place some kind of typical coffee grows. If that kind of company is there, it is a long business model. Nobody is going to stop drinking coffee anytime soon. It has been from hundreds of years people have been drinking coffee. At the same time, they have some specialty, some competitive advantage, and the business model is not able to disrupt. And these kind of companies are called consistent compounders. Okay, these keep growing every single year 15 to 25% in a consistent way. And those companies should be your long-term bets, which will protect your capital in the first place. There won't be too much of disruption. You can sleep well for long term, and that is what we include in the core portfolio side of companies. And satellite is where everything else will fall in place, right? So any cyclical company where things are up and down in 2-3 years, like sugar sector or steel sector or paper sector, textile sector, right? Things moves very fast in those sector. And then, any kind of special situation if you want to play. Any kind of companies which are not great companies earlier, but they are developing new competitive advantage or started growing or started building some longevity kind of product. You want to experiment and test it out for some years. That also can form part of satellite portfolio. So that is how you can do best of both worlds. And I created a video of top 5 sectors. Let me see if I can check it. So this is where, I have created a separate video on our channel, top 5 sectors to watch for next 5 years. These are the sectors which fit in properly in your core portfolio companies. So combining both the insights, like one video on core satellite, what is the thought process, and then ultimately boiling down to which sectors are more that kind of compounding sectors, you will get a lot of ideas to work upon. Yeah. So thank you so much, Vivek Kumar. Hope you were able to get the answer. Okay, Rajan Singh is saying Vivek ji GPay link is not working in YouTube join link. This is very specific to YouTube platform. You know, I don't have any role to play in this. It is not my direct link. YouTube basically collects the payment for all the members and then they basically transfer to all the YouTube creators. So I don't know. You might probably want to, you know, write to the YouTube guys. I'm not sure why that is happening. Okay. Awesome. Let me get to the next question. Awesome, awesome, awesome. Let me scroll through. Okay, Praveen Kumar is saying, you know, how to select multi-bagger stocks. I think it's a long answer again, so I would highly recommend all of you to watch this session. You know, fundamental analysis of stock using Excel screener. That is where you will be able to understand how to find such multi-bagger stocks, and the entire process is covered there. Yeah, so thank you so much for asking that. Okay. Okay, Himaga is saying, sir, how to ride high P and price to book value stocks like Sona Camster, RHIM, Clean Science while they are in uptrend and avoid downtrend. How many of you want to know the answer of this? Just type me in the comment box. Okay, I'll give you a very, very simple framework. So first framework which I use is called stage analysis. Okay, so there are, each stock goes into stage 1, 2, 3 and 4. It is covered in my book also. If you have not picked up my book, you can go to this link and you can actually pick up my book also. This is the link of my book. You can go to technofunda.co/book and you can avail it. But I'll give you a very, very simple framework with entry exit how you can do it. Okay, so all of you are ready for this, just type ready in the comment box. Let me share it with you. Okay, so let's take example of Sona Camster itself. This is the one, right? Sona Precision Forging, or it is, yeah, Sona Comps, right? This is the one. Now, so what you should do is anything which is medium term, right? Sona Camster kind of company are not typically short term. It is medium term. Let me see if we can get a BSE chart so that it is much longer. I think it's same, right? Yeah, it's same. I think it is just recently listed. So now I have drawn this, chart for you like 2, 3, 4. One, it is not having a base because it was already IPO'd and probably, as soon as it got IPO'd, it was starting the trend. So it went into second stage, which is called advancing phase. That is where, rapidly the re-rating is happening. The earnings growth might be there. Then the third is, distribution phase where, smart money is getting out. And the sign of that is when it is starting to form the peak, the volume will increase, a lot of people are interested, but the price will not go up. In fact, this is the topic I am going to cover on Sunday for all my paid members inside my community. For 3 hours we will do this. I am just explaining you the summary of it, but we will be doing this 3-hour dedicatedly deep dive. It is called stage analysis, and once you learn this principle, your aim should be only to ride from here to maximum this part where the stage 4 is starting, and to avoid this entire stage 4. See this part, okay, this part, let me make it red. This part is the cause of major wealth distraction. If all of you agree with that, just type agree in the comment box. Because when you are down from say 800 rupees, you come down to 400 rupees, 50% down, to reach that same level, just to break even, you need 2x return or 100% return. Okay, which is very, very difficult because it takes so much of time to happen. Now, very simple indicator all of you can use in this kind of scenario is called zigzag indicator. Okay, this is the indicator you can use where it will show you the Dow theory, higher highs and higher lows. And when it forms the lower lows, you will know that the story is over. What I do is I use some of the other indicators. I use likes of EMAs to exit. So let me just remove all the drawings so that you can understand. So say EMA will give you exit, say somewhere here, at least I am prevented. And I use my own customized indicator, which is called Shaktiman. So this will also help me to ride this entire trend and avoid this entire trend. Can you see it gave me exit somewhere here and I was out almost this entire time. Okay. So this is how, with simple techniques of technical analysis, you can use it. Let me go to the next one, which is clean science, right? Let's go to clean science and do the exact same thing there. So if you do clean science, if we go into the weekly chart, a similar thing you can see over here. Can you see this? Like the entire period you are out. Okay. And even if you use simple of EMAs on all those things, you are still out. The point is you should have a framework to do this. And even if you use zigzag, it will take you out. Okay. Slightly late, but it will take you out ultimately. Okay. Same way you wanted to check for RHIM. You can check RHIM. Yeah, same thing. And for RHIM, it is more like a core stock. So ideally, you can even use monthly time frame. So this is how you can use monthly time frame also, and you can prevent all the drawdowns. Okay. So hope this was useful. Thank you so much for asking that question, Himaga, and hope this was useful. We are going to cover this in our community on Sunday, like 5:30 to 8:30. We are just doing this stage analysis. Awesome. Then next come to the next question. Got it. Himaga is asking why 70% in core and 30% in satellite. See, there will be phase where, the market will be non-trending. Okay, it will be non-trending where you cannot do much. If that point of time, you hold too much of cash, right? Like say if you do 50-50, 50% core and 50% satellite, then it is very difficult to generate optimal returns across your portfolio because your 50% is not working in your favor, right? So that is the reason to have more of a core portfolio. The second is in 30% you also need to keep hunting for ideas every single week, and you will only get so many of ideas every single week and every single year. So that is the reason, you want to do it more peacefully. You can put more into core and more into satellite. Of course, when market is trending, everybody wants to do full satellite, but there will be phase where nothing is happening and or sometimes, even the satellite stocks are falling drastically. That happened in 2018. That time your core portfolio will give a lot of stability to your portfolio. So you have to think about it, whether your focus is stability or fast income generation. Again, nothing right or wrong about it, but my first preference is always capital protection and risk management. That is how I am very conservative in nature. Okay, even in satellite portfolio, I do it very conservatively. I always focus on risk. I always respect risk and then think about returns. Thankfully, the returns are coming automatically, but that is how the thought process is there. Okay, but you can tweak it. I'm saying it is not like a written on stone. You can do 60-40, you can do 50-50, but it is just stability versus the reward. It is a trade-off. Okay, great. Thank you so much for asking that. Yeah, Sanjeev Kumar is saying if main work of a person is investing in share market, 1 hour daily is enough for this work. What that person will do in remaining time? Very good question, Sanjeev Kumar. And when I started doing full-time investing, right? So I was investment banker earlier, very hectic job. Like I used to do 15 hours of work every single day. Many times I used to come at 3 o'clock, 4 o'clock, 5 o'clock in the morning, after doing work. That kind of grind I've gone through, and only time I used to get on investing was during weekend. And with patience and discipline, every weekend, 2 hours I used to spend, and then, I started compounding in a better way, and then I was able to quit my job because I need not do all those things full time. And before going full time, I actually experimented. For 1 month, I took a leave and behaved like I am a full-time investor, what I will do. Okay. And that is where what happened was I became too active because there was nothing else to do, and I was forced to take action only inside investing. That used to happen with me. So that overactivity was actually reducing my returns because I was taking too many unnecessarily in and out positions. And that is where I thought that, okay, now if I want to actually become full-time investor, I need something outside, stock market, or even if it is not outside, it is connected to stock market, but taking away my time from screen time. That is the best combination which I'll do. And that is where I built investing community, where I get engaged. I do all these things where I impact the society. I help other people. At the same time, I have written a book also. All those things, it is helping me to grow myself. See, when I'm answering all these questions, it is also helping me grow my mindset and helping me improve and learn. Okay. But at the same time, I'm also not focusing too much on the screen time, just refreshing the prices. Right. So I can research companies, I can share my research with others, and when you teach somebody else, your learning is much faster. Okay. Others will definitely learn, but you will learn much more in that process. You will also get disciplined, and that is where I wrote the book also. I do a lot of stuff in terms of technology. I keep learning new things like coding and all those stuff. And that is where you have to find one area of passion, okay, where you can spend some time, at the same time it is productive, and even better if it gets you some cash flow, no harm in it, right? When there is some bit of cash flow coming in sideways, it will always help you to navigate the market even in kind of volatile conditions. Okay, so if you are just sharing value and helping other people, there is no point in not getting paid for it also, because people will only value your service if they are paying for it. It is for them, you should charge, and in that process you can also withstand some kind of volatility. So my point is, find something which is either connected to market or even not connected to market, which is helping you grow personally as well as taking out some time out of your screen time. You are pretty much right that it will only take 1 hour daily. It is more than sufficient. Okay, but think about it. Go deeper and think like, what really would you like to do? For me, it is like education, investing, and technology. These three areas, you give me whatever, 3 o'clock at night, you tell me to do YouTube live or teach somebody or help somebody understand any concept, I can do it. Okay, if you ask me to simplify something, I can simplify to the hell. So that was my 3 areas of core strength, and whatever I'm doing, I chose around those 3 areas. You can choose yours. Okay. So hope this was useful, and I'm sure a lot of people who are listening here, it might be useful for all of you also, because see, achieving financial freedom is one challenge in itself. Okay, to grill around that. But after you do that, there is another set of problem which starts. And that is where you have to think deeper and try to find ways to overcome that also. Okay. Superb. Thank you so much for asking that. Short question, big answer. Generally, that is the case. Okay, how do I start this process? Amish is saying, I am lost on your website. So, what you need to do is you just go to the learn section of my website. If you want to take membership of my, community, that is where you can go. So you can go to the learn section inside my website. That is how you can get started. If you are already part of my community, you can actually go to school.vivekmashrani.com, and you can go to the first module, which is Financial Freedom Blueprint module, and you can go through the launch orientation. That is where entire journey is covered. All the resources and the links to join our private group and all those things are covered. Okay, so here the entire sequence of the modules is covered. The different private group, social network, all these links are also covered. So you can go and check it out over there. Yeah. So hope that was useful, Amish. So that is just one-stop solution where you need to go once you are part of my community. Rajesh is saying, please suggest which one should we go for, long-term dividend paying as a retirement. Okay, so see, for retirement, stocks you should not consider something like a fixed income. Always understand the equity or stock investing is a tool for growth. Okay, it's a growth related investment. So your focus in equity should be to make it grow, get as minimum dividend as possible. Why? Because if they give dividend, they are not able to put that money back to business to grow their business. So for your growth oriented bucket in your asset allocation, you use equity. If you want some fixed amount, right? Even NPS provides that, like you put initially into equity and fixed income, then everything when you retire, it gets converted into annuity, which is more of fixed income kind of product. and you get like a monthly income every single month. So that is how your focus should be. Don't put into dividend yielding stock like high dividend 8, 9, 10% yielding stock, because either they are low growth stocks or they are disruptive business where there is no future and hence they are giving back all the money. Say for example, Coal India, right? 20 years after, I don't know if Coal India will any which ways be existing or we will be using coal kind of energy to produce our electricity and all other needs. It will be predominantly clean energy, renewable energy which will capture that space. So that is a disruptive business model. It is not going to survive for a very long period of time, and hence these kind of companies will give high dividend yield. Or say a company which is not able to grow and struggling to survive, they will give back dividend. So just think about this in a deeper way, and then you can take your decision around it. Okay. Thank you so much, Rajesh, for answering this. Guys, if you are finding this entire session very, very useful, just hit a thumbs up so that I know you are finding it useful. And I've shared a couple of interesting links also inside the description. You can go and check it out. And if you have not read my book, you can order my book also. It's called You Can Compound. It will be available on Amazon. It's a #1 bestseller on Amazon. So you can just search with You Can Compound, and you can also check it out, my book also. Yeah. Awesome. So let's go to the next question. Okay. Sandesh Kamble is asking, what should be exit policy in core portfolio? Like, do we check weekly or monthly chart if following EMS? So for core, ideally focus on monthly chart. Okay. So if it is like a long mega trend companies, long-term compounding companies, focus on monthly chart. If it is like a 3 to 5 year kind of trend or 5 to 7 year kind of trend, you can follow weekly. Or a lot of members, what they are doing inside my community is they are blending both these things. So they are doing 50% into monthly charts and 50% they are following weekly charts. So first 50% exit you take based on monthly, second 50% you can take it on weekly. So that is how also you can blend it. So hope that was useful, Sandesh ji. Thank you so much for asking that. Manisha is saying, do we need to follow the candlesticks if we are entering using chart patterns or moving average or support plus resistance? So candlestick, yes, it will give you some insights in terms of demand supply. What I use is even deeper concept inside candlestick, which is called volume profile, right? This I cover in my advanced modules inside our community, but volume profile is something which will help you along with breakout, whether there is enough demand of that or not. I'll just show you a couple of examples so that you will understand what I'm talking about. So let me just pull up a couple of one of the charts, and I'll show you some breakout, what is happening, what is the logic. Let me find out a couple of them. Okay, so let me share the screen. Let me come to this chart. Okay, it's RHIM chart which was there earlier. So I'm just randomly picking up this chart and I'm showing you what does it signify. So I'll right now remove the body so that all of you can see the candles inside, and then I'll add volume profile to it. Okay, so go to profiles and I'll go to session volume profile. So now once I open this up, and I'll just zoom it a bit so that you understand. So blue area, whatever you see inside, okay, is market order. So when there is huge demand and people are hitting market order. So if you see, this area is all blue market order area where people are very, very bullish. And yellow is where people are selling with a market order. Now this is where on the top side a lot of selling was happening. Even on this candle, a lot of selling was happening. So that gives you an idea that this breakout might not be sustainable because there are sellers on the top. Same way, when this breakdown happened, there were so many sellers on this entire candle, and that means that probably this downtrend will continue because there was nobody literally to buy that with the market order. There was no conviction for people to buy. And here in the base itself, you can see on the top there are a lot of market orders. So there is a lot of blue on the top side. That means probably the uptrend is now getting started. So not only just the breakout where this was a breakout zone and it broke out, but it also gives you idea around what is moving and why it is moving within that candlestick chart pattern also. Okay, so if this was useful to all of you and never thought or heard about it, just type useful in the comment box, because this is where you get a deeper insight what is happening inside the candle. We are not even seeing outside the candle, we are just going inside, and like x-ray we are going and checking their body, like what is happening here. Okay, awesome. Thank you so much, Manisha. Hope this was useful. Anirban is saying your advice on government SGB. So see, personally, I prefer buying gold as a physical gold. Majority of the portion which I want as a liquid part of my gold. Why? Because gold is something which you use predominantly when there is, say, war or an earthquake or some unseen event where you cannot even log into your computer. You have to just run, and you don't know what is going to happen to the world. And that is where you want a physical form which you can give overnight, like at 3 o'clock at night to somebody, and they give you money in return. Okay, so the major use of gold, or the purpose of gold, is that. Of course, you can use it for hedging and all those things where SGBs are fine. Okay, and good part about SGB is that you get 2.5% interest, and there is no capital gains if you hold it for like entire term of 8 years. So in that aspect it is good, but the downside is there is no liquidity sometimes. If you want to sell say SGBs of say 5-7 lakh in one shot in one fine day, sometimes there is no liquidity at all for your tranches. So if you consider liquidity, if you consider what is the core purpose of gold, some bit of physical gold is much needed. Okay, so at least 10-15 lakh worth of physical gold at your home, which you can access anytime, is advisable in my view. This is my personal view. It can be different for different people. Okay. Superb. Sanjeev Kumar is saying, suggest me the name of authentic platform to invest in unlisted stocks. So see, unlisted stocks, you have to actually find there are unlisted brokers who do it. You can email me on connect@vivekmashrani.com. I can help you connect with few people. But it is a very clean way in which this happens, right? So basically you give a check. You don't actually give any cash or physical money as such. You give money in check. It goes to the company or the person if it is a resale, and you get shares in your demat account after forming all the agreement and documentation. So it's generally a safe way. Of course, there will be some bit of bid-ask spread because of information arbitrage, because of which you will need a credible broker for that. But generally, it's a clean transaction. But I would say, rather than doing into unlisted space where there is no liquidity, the ticket size is big, and some of the good companies like NSC and HDFC, there is one arm which is getting listed. The valuations are not that cheap, versus the kind of liquidity that offers. There are lot of better options in the secondary market which you can explore. Okay, so just do that. Okay, Sudipta Sutradhar is saying ROAE or ROCE, which to consider and why. See, first you should consider ROCE, right? Return on capital employed. Basically, it tells you how much return you are generating on the capital employed. Say, what is your EBITDA, or EBIT, divide by your total capital, whatever is your borrowing and your equity. So it tells you that, okay, on this particular capital, say you put in 1 crore rupees, 50 lakh debt, 50 lakh equity, on 1 crore you produced, say, 10 lakh of EBIT. So 10% is of return on capital employed. Now some company can use so much of debt, more debt, right? And they can, magnify the return on equity. And that is where, if you just look at return on equity, you might get, lured into wrong side of things, because then you are ignoring the part of debt which a company is taking. So both in combination should be used, but if any one of them should be used, ROC is a better metric to first start your journey, because it covers both the form of capital financing for the company. Okay. Anirban is saying, please tell us something about some good corporate bonds where yields are high and safe. See, when yields are high, it automatically means the safety is low. Getting me? So in fixed income, remember this rule. Always, please, all of you can write this. Remember this rule. If you want to go in fixed income, go with the safest option. And if you want to go with the safest option, the yield will be generally lowest. So the government bond, right, the GSEC, takes the government of India bonds or RBI, which they are putting the bonds, they will have generally the least, yield or the interest which you will be getting. And those are the most safest one. Anything which has a premium over the government bonds, that means they are riskier. They have lower credit rating or they have more risk embedded to it. So when it comes to fixed income, think of safety. When it comes to equity, think about growth. So don't buy high dividend stocks just to get a fixed income in equity, and at the same time don't focus on too much of return when you are buying fixed income. Think about safety. So fixed income, safety, growth is equal to equity. If this thumb rule was useful, just type super useful in the comment box. Okay. So we'll do this 15 more minutes, since all of you are super powerful audience and all of you are hitting thumbs up again and again. So let me do this 15 more minutes. All of you are fine with that. Just hit a thumbs up again. Okay. So let me. Yeah, Anirban is saying, how is NCD as an investment? Again, same thought process. NCD are generally high risk instruments. Prefer GSECs over NCDs. Okay, even if you are buying NCDs, buy a mutual fund where there are underlying multiple NCDs, so that there is not a blow up risk. Okay, this happened in DHFL. A lot of people bought DHFL NCDs and even secured FDs. They were not able to get full money because blew off. Okay. Yeah, Fanindra is saying, sir, is there any Excel sheet which can tell the stock target price? I've attended one of the webinar and saying he has prepared powerful Excel sheet which can tell. Yeah, so basically what we have done is there is a summary sheet in the Excel which I was talking about it, and then we have covered a detailed module on reverse DCF. Okay, reverse DCF, where you can actually get an idea what will be the end multiple based on the current growth rate. So that is how you think about it, and then reverse calculate the target price rather than directly coming to the target price. Okay, so it's a slightly tricky way we are going about it. Okay, Sandeep Shah, thank you so much. Just became the member. Great to have you inside. Welcome aboard. Yeah, Aviraj Patel is saying your views on DMart stock has corrected considerably from top, even though fundamentals are intact. I think one, the fundamentals have also changed. Second, the interest rates have gone up, so naturally, people will prefer, better yield outside equities. So that is where the multiples overall has compressed. But if you think about, DMart, let me share the screen. It's actually, still very, very overvalued, share as such. Again, it is my personal view, not a recommendation. You can do your own diligence. But after all this correction also, it is 93 times P. And if you see the growth rate, right, it's not growing that much. How it should justify that kind of P multiples. Okay, so like recently, last 3 years, 5 years, the growth is not that great. Okay, so it is probably, it's just discounting the multiple, high multiple. And even if you consider the exit strategies, right? So what we do in these kind of stocks is we have exit strategies in place. So here we can actually cover weekly charts. And if you see the stage analysis of this company, which I covered in today's session also earlier, see much before it actually generated exit. Can you see this? Like from almost 4,500 it generated exit. Right now it is somewhere around 3,400. So when you are picking high P stocks, ideally have some kind of exit strategies in place. Okay, so that is some insights for you. Again, you can re-evaluate if it is justifying your valuation and whether your initial view why you bought in the first place is syncing with the stock price. Okay. Yeah, Prahlad is saying usually you advocate buying at breakout, but what about picking at reversal point? You can definitely pick up at reversal point. The problem with reversal point, I'll tell you what is the problem. Okay, so let me pick up one such chart. Okay, let me pick up one such chart, which is very recent chart of such fall and all those things, and what happens to these kind of companies. So let me share the screen. See, for example, you picked up, say, Sequent Scientific, right? And usually what I like to pick up is, like, as you said, if it is breaking out here, I want to play this part, so when it is forming a new high territory from stage 1, it is going to stage 2. I want to generally play this part where it is going into new high territory, and then of course my exit triggers in stage 4. So from this part to this part, my exit has got triggered. Okay, so I'm not participating in this entire phase. Now, say for example, this kind of thing have happened, right? So it has just got a breakout, and now weekly chart also it has moved 20%, and now it is telling you probably it is a turnaround story. Now my logic is, all these guys, all these guys who you see here, these are all trapped guys. Okay, these, some of them bought at 300 rupees, some of them bought at 250 rupees, some of them bought at 210, some of them bought at 200, some of them at 180, 100, 95, and so on and so forth. So what is the general psychology of investors? First, when it is going down, right, they don't want to sell. Yes or no? All of you type yes or no. When it is going down, there is a psychology which is called loss aversion. We don't like losses, right? How many of you like losses? I like taking losses, because when I know I am wrong, I am the first one to book the loss, because I know that if I am wrong, I'll make more losses on this position. So I want to take lesser loss. So you have to reverse the psychology, that lesser loss or higher loss, which one you want to choose, rather than thinking, how can I take this loss. But majority of the market participants, I also used to do like that when I started my journey. Okay, I used to hold all the stock all the way down, average down also. Now I don't do it, but that is the normal psychology. So somebody at 300 rupees, they will think at 250, यार अभी इतना तो गिर गया है और कितना जाएगा नीचे, let's hold, अभी इतना ले ही लिया है. Then it will go further down 200 rupees. Then they will think, oh, why not to bring down the cost by doing averaging down. So all those things will play in their mind, and a lot of people will be stuck out there. All these people are dukhi atma, okay? They are like all stuck inside the stock. Some have averaged down, किसी का 10%, 15% portfolio भी हो गया. Now, as soon as it starts moving up, what is the psychology? भगवान गिव मी ब्रेक इवन, अरे कॉस्ट टू कॉस्ट हो जाए, 90 का एवरेज प्राइस है, 90 हो जाए मैं निकल जाऊंगा, 100 एवरेज प्राइस है, 100 हो जाएगा, आई विल गेट आउट. As soon as my average is done, I'll get out. So what will happen, as it starts moving up, these guys will start selling, these guys will start selling, these guys will start selling. As it keeps moving up, there will be a lot of resistance on the way. If this makes sense logically, just type MS in the comment box. This is what will happen when it starts going up. So I don't want too many dukhi atmas on the way. I want a stock which is forming a new 52-week high, making a new all-time high. Everyone is happy. Nobody is a seller. So the stock will move much faster relative to these kind of stocks where there is turnaround. Now, I'm not saying it is good or bad. It is just that it takes slightly more pain to do that. But another angle to look at it is that stock should be into stage 2. It should be from a base, it should be forming all-time high. It should not be like a stage 3, the distribution phase from where it is trying to go up. Then the move will be much smaller, right? Because the valuation will always be elevated at that point of time. So you want to go from low valuation to high valuation. You want to go from stage 1 to stage 2, but you don't want resistance zones in between. So here also it is stage 1 to 2, but there is a past stage 4 which has already happened. So I don't want to prefer that. So Prahlad, hope this answered your question and that gave you clarity. Again, I have seen a lot of very good smart investors who are able to pick up reversals and make money. It is just that I am still learning. I have not mastered that art, and I prefer the other side of story where I am good at. Okay. So that is, and with a logic, right? That is the logic why I am doing it, what I am doing it. So thank you so much for asking that question. Rajan Singh is saying how to join your service. So you can just go to vivekmashrani.com. You can see, there is a learning module. If you want to learn, you can start learning and you can grow. If you want to just experience what is system building and how this happens, I'll give you a free workshop link which you can join, and you can, join this upcoming webinar. I've shared the link also in the description as well as in the pinned comment. You can join this workshop if you feel it is for you. You can always go next level in your investing journey. In this workshop, I generally cover all the system building part and I go deeper into all these concepts which I am discussing right now. Okay. Great. So next question is, Imran Pasha. Can you say about sector rotation, when to buy this sector? Which sector? Okay. So this is a very, very good question. What I simply use is something called as price volume action. I use this tool called ridewinners.com, and in this particular tool, I have screens mapped with a certain sector. So say for example, there are a lot of companies coming on building and heavy project side. I know that this sector has started moving. And then I go to the trend screen of this, where I see, whether this sector is really coming again and again. So I can just filter building and heavy projects. And then I know that, okay, it is coming multiple times, multiple companies are coming in the screen, and many companies are also forming new highs inside this sector. So then I start looking at this sector very, very seriously. So I make the use of price volume action to think about sector rotation. I take a tracking position and then go deeper into the fundamentals, and then I build the position. So that is the entire process which I follow for finding the sector rotation. Basically, I let market tell me what to do. Okay. Thank you so much, Imran, for asking this. Imran is asking. Okay, we have Imran Pasha and this is Imran Kazi. So Imran is asking which tools you personally use. So I have created again a video on lot of these tools in my channel. Let me see if I can grab the link of that video. Okay, so this is the video which I have created. You can search with top 5 stock market analysis tools for India in my YouTube channel, Vivek Mashrani top 5 stock market analysis tools, and you will find all the best tools which I am using. Okay, so all top 5 tools you will be able to find it there. Okay, great. Thank you so much, Imran, for asking that question. Okay, Mukesh Patel is asking ideal stop loss and how to trail it. See, there is nothing like ideal stop loss. It is basically how much you are willing to take in terms of risk and how much reward you are generally taking, right? So it is always and always risk reward. What number of times you are placing your risk reward. So if you are doing any risk, if it is 10% and you are able to get on an average 30% move, it is 1:3 risk reward. Great. If you are doing 2% and able to do 6%, it's great. If you are able to have a 30% trailing stop loss 3 times, like 100% return for long-term monthly charts, great. So it is the starting point should always be risk reward, and based on risk reward, you should decide your stop loss. Having said that, again, it depends on the time frame also. Like if you are in a very short time frame, you of course will have a smaller percentage of stop loss. If you are doing weekly, then you can have slightly more bigger stop loss. And third, if you are doing on monthly, it should have even bigger kind of stop loss, you can place it. And it also depends upon the underlying businesses. If you are doing into a core portfolio, strong companies like Asian Paints, if you put a 2% stop loss, every single day it will hit. Okay, so there you have to put slightly wider stop loss. But company which is highly cyclical, you have to place a tighter stop loss. Okay, so the faster the company is moving, the tighter the stop loss you can keep. And where it is stable compounding companies, you can give more room to it. Basically, the stronger the business model, the more room you are keeping it for triggering your exit. The tighter or the more volatile the business, you are giving it lesser the room. That is how you can think about. So what I personally do is, in my first tranche, this is for satellite portfolio, first tranche I make sure it is less than 10%. In single digit, that stop loss should be there. and then I follow multiple indicators to go about it. In fact, I have created my own custom indicator which is called Shaktiman. It is private indicator. I'll just show it to you, which I have built for myself. So this indicator which you are seeing right now in front of you, that is my indicator. So on an average on weekly chart, it is somewhere around 10 to 15% drawdown it takes. So say for example, if Sequent, it came to say high was somewhere around 304, around this area it will trigger my exit. So around 15% it will trigger my exit. So that is how I have built my indicator. Again, you can do partial exit and positions, sizing also you can change. All those things are embedded inside it. So this ABC which you see, C is the highest position size, B and A is lesser position size. So that is where you might probably want to offload 50%, and then when this triggers you want to offload the entire thing. So this is how I go about it. I've customized and I go much deeper. As I said, I do a lot of coding myself, so all these things have come up from that. Okay, so thank you so much Mukesh ji for asking that question. Let me Yeah, Bodhanapu is saying, please do every week. Thank you so much. I'll try to do as much as possible based on whenever I get this kind of opportunity. Thank you so much. Bharat Pete is asking, SGB or gold ETF, which one is better return wise? Please advise. So see, gold ETF, how it works is, whatever amount is there, say 1 crore rupees, all the investors have pulled, they will buy gold worth 1 crore, put it into the locker, and somebody will be managing it passively. Okay, so there will be some small cost, like say 0.1% every single year on that entire amount. So that 1 crore will keep shrinking every single year, small percentage, 0.1%. Of course, that gold prices will increase, so that amount will grow, but there is always a tiny expense to manage that ETF. On the top of it, there is no return apart from the price appreciation of gold as such. But in gold bonds, you have 2.5% interest which government gives you, and there is no additional cost of management. So cost wise, zero cost, and return wise 2.5% return. So if you compare both these parameters, definitely SGBs are much better than gold ETF. Only thing is, gold ETF might have slightly better liquidity. SGBs might not have that liquidity. So if liquidity is concerned, then you might think about ETF. If liquidity is not that much a big concern, then definitely SGB is hands down. Okay, so that is what is in the terms of SGB. So great, thank you so much guys. We have done almost like 1 hour 20 minutes together, and those who are there till the end, I want to congratulate and thank all of you. You are super learners, and if you are not part of my Telegram channel yet, you can join this free VIP Telegram group, exclusive group where you can connect with me and you can learn together. And we will keep on doing this again and again. Thank you so much guys again for joining this. And make sure all these things in terms of stocks are all case studies and examples which I showed you. Nothing is like investment advice. So make sure you are consulting your investment advisor for any kind of recommendation. But really appreciate your time. Thank you so much again. And we'll see you in next upcoming session. Thank you so much.